In option strategies, there are three types: neutral, bullish, and bearish option strategies. These are being used when we feel that the underlying asset price will fall in future. Let us see few of those in this video. The reason for publishing this at this time is we feel that the markets will correct a bit now. So we thought if you are also in the same view, we might be useful to you. So let us start our video. Hi viewers, Namaste. Welcome to the world of GetTrading. Let us take Nifty as an example. Nifty's present price at Tuesday closing is 10,607. We will see 30th July expiry option chain. What is the at the money contract? 10,600, right? And we feel that by 30th July, Nifty may touch 10,200. So with this view, we will see what type of option trades we can try. You can simply say that we will buy a put option of 10,600 strike price and we'll wait for a fall. It is absolutely correct, no problem. It is called a naked put trade. Okay, let us suppose we took the trade. At this present scenario, we must pay 206.4 rupees for premium to take the trade. So, when in expiry, if price falls more than 10,600 minus 206.4, that is, if it falls more than 10,393.6, which is the break-even point, we make profit with the fall, right? What will be our risk? The whole premium, 206.4 times 75 per lot, which is also the capital required, 15,480 per lot. What is the profit if our analysis proves right? That is, if it closes at 10,200, our profit is 400 minus 206.4 into 75, 14,520 rupees per lot. Now, if you feel that the profit is less for this move, let us check more in the money contract, that is 10,700 strike price put option. The present price, that is premium of this, is 257 rupees. So, capital required 19,275 rupees, which is the maximum loss per lot. If price closes at 10,200 on expiry, as we expect, the profit is 500 minus 257, that is 243 rupees into 75, rupees 18,225. Okay, let us once check at different strike prices if we are long in the puts and at present prices. The data of capital required, profits, risk is shown here. So, depending on our capital availability, risk appetite, convenience of our risk to reward, etc., we should select our trade. Hope you got it. Many people ask whether to buy an in the money contract or at the money contract for a particular view. The answer depends on your decoding of this data. Please pause this video if you want to cross-verify the data. Okay, let us take one contract for example to move further. Let us take the same 10,600 put buy which you have seen before. What is the maximum loss per lot? 15,480 and profit unlimited. But we are expecting the price to reach 10,200. So, profit if it reaches there is 18,225. Expected profit. Risk to reward ratio is 1.17. That is, if you risk 117 rupees, you may get 100 rupees. Do you think experienced traders are okay with this? No. They want the risk to reward ratio at least 1. And also, few traders work very hard to reduce this risk, even decreasing the expected returns. This is the time strategies come into picture. The trade we had seen is good, but let us add one more trade to it. Let us add 10,400 put sell trade, which is of the same expiry and same contract, of course. Premium credited is 129.5 rupees. How will be the combined payoff diagram? This it is, right? Maximum loss will be 76.975 times, 5,768 rupees per lot. Maximum profit will be 123.1 into 75, 9,233 per lot. If any doubts, please watch our playlist or at least payoff diagrams video first. Okay, let us see what will be the margin required for this trade. let us see it in Fire's margin calculator. See here, the margin required for shorting Nifty 10,400 put option is 1,20,000 approx. But since we have an option buy which is to be protected, our margin requirement is just 15,792 for both these trades. I think you may be aware that SEBI has given this margin benefits for protection trades recently. This is why we started to stress on these option strategies, and we will continue from here. As said before, watch the videos in the FNO playlist one by one to get better understanding of this. Also, if you haven't subscribed to us till now, please subscribe to our channel and press on the bell icon for instant notifications. One more thing, you may be aware that we are authorized person for Fire Securities, free investment zone, 30-day challenge, world-class trading platforms, best customer support, less brokerages, decent margins are the few of advantages of Fires. To open your account with Fires through us, please find the link in the description box below and submit your details in the link opened. Our Fires representative will call you and will open your account. Okay, coming back to the topic, if we see this trade compared to the put buy alone, this can be said as a strategy, right? We may be missing unlimited profit, but we have a disciplined approach to the market. This strategy is called put spread option strategy. These are few more combinations of this strategy. Change in variables. Some of you may have noticed by now that margin required for this strategy is even less than the margin required for buying a put option alone. In other words, after buying a naked put option without extra margin, we can place the needed put sell trade as you are restricting your losses. Now, if we are bearish in any stock, one thing is buying a put, which we saw. What is the other approach? Selling a call, isn't it? So, let us suppose we have shorted a 10,600 call option. We will receive 217.95 into 75. 16,346 rupees as credit, and this will be our maximum profit. Even the price reaches the 10,200 mark which we have thought, the profit is 16,346 itself, right? But the problem is, if price moves away from 10,806.4, the break-even point, the loss is unlimited. 75 times the price moved above this price, isn't it? To restrict this unlimited loss, we can add another trade. This time, we can add an out-of-the-money call option. We buy it. Say for suppose 10,800 call option buy. We need to pay the premium for it, right? And for this example, it is 125 rupees into 75, 9,375 rupees. Margin required for these two trades combined is, let us check in Fire's margin calculator again. For only selling call option, we need 1.3 lakhs approx. But if we add this buy trade as a protection, margin required is just 31,337 rupees. Just is when compared to 1.3 lakhs. Okay, let us see the combined profit or loss of this combination. Maximum profit is 6,971. Maximum loss is 8,029. Yes or no? Okay. Selecting which combinations to trade solely depends on the current situation, that is the premiums. Making the tables of this type, analyzing the defined target with defined time, you can quickly take a decision. Making ready the data is important. Anyways, depending upon the capital required, risk, rewards, and after comparing those, you can make a good trading decision. This is what I intend to tell. This viewers is about the few of bearish option strategies. Let us meet in our next video. Till then, have a happy, safe and profitable trading. Jai Hind.